Hi, I'm Tim Craighead, Senior European Equities Strategist at Bloomberg Intelligence, and I'd like to share a few thoughts related to our recent note on the FTSE 100. Now, from a market perspective, arguably the key fundamental risk from the Russia invading Ukraine revolves around operating margins. Let's start with some critical background information. You can see here in this chart that forward operating margin for the FTSE 100, which is in the white line, is back near its historical peak. Now, similar to past peaks, this is coincident with spiking commodity prices. Now, at the same time, consensus earnings expectations are rising, most recently being spurred by better than expected 4Q results. Now, admittedly, like the market, we've been surprised at European and UK profit resilience in the face of rising costs. Now, cost mitigation was a key phrase across many analyst calls. We fear though, that risk of disappointments is just getting larger in the wake of the implications resulting from the Ukrainian invasion. Now, let's dig into some details. With the UK market having uniquely large exposure to energy and metals, it's important to break these segments apart from the rest of the market. You can see here that margin estimates are at peak for both the commodity group and the rest. Now, energy and materials, that makes sense to us with spikes in underlying commodity prices. What's concerning, however, is that expectations are high and still rising for the rest of the market, which will be increasingly confronted with having to buy rapidly inflating input costs. Think consumer staples and industrials. These are particularly notable here, and the FTSE has plenty of both. Now, this table shows a different cut on the margin story. Consensus expectations for every sector, bar two, is projected to be rising in 2022 and 23, and all are above pre-pandemic levels achieved in 2019. Now, considering rising costs from inflating energy, metals, and agricultural commodities, we have concerns about many consumer staples, discretionary, and industrial companies. They either need to extract more savings on an already restructured cost base or offset rising expenses with higher prices. Now, we're skeptical on the sustainability of either of these strategies. So what does this mean for the FTSE? Well, negative revisions are definitely a risk for much of the market as we look into 1Q and 2Q earnings. But this is being offset at the moment by upside in energy and materials. Now, this has happened before, as you can see in this chart, where commodity and non-commodity segments have diverged, and basically the FTSE has tread water. Now, in a bit of deja vu, the FTSE is outperforming the rest of Europe in today's market, largely by falling less on down days. Now, it may seem counterintuitive, but at a time of rising commodities, the UK becomes something of a safe haven relative to other more diversified traditional markets. Now, if you'd like more detail on any of this analysis or our views across European equities, come to our dashboard on the Bloomberg terminal, BI Stocks E. And please reach out directly to us, email, IB, etc., if we can be of any help. Hope all is well, and have a good day.